Hello, this is Jeremy North with your educational and economic update for June of 2022. In this month's video, I'll discuss major headlines that influenced markets in May and early June, along with economic and market events that we are looking at to influence July returns. Please stay tuned at the end of this video for the always exciting required disclosure statement. Well, another week of very volatile trading and falling stock markets have put the S&P 500 past the bear market level, down over 20%. 2022 has been the worst start to any year since 1932, and what is normally a safe haven with long-term U.S. Treasury bonds, they are also down big, over 23% year to date. So far in the second quarter, we are seeing continued positive corporate profits, but analysts have some concerns and think that earnings will drop in the second half of the year. These concerns continue to be the same as they have been for the months: COVID, supply chain issues, and most importantly, inflation and rising rates. In fact, tightening monetary policy combined with inflation running at 4-decade high has many investors fearful that the economy might go into a downturn or recession. Federal Reserve Chairman Jerome Powell stated, "We understand the hardship is high inflation is causing. We are strongly committed to bringing inflation back down, and we are moving expeditiously to do so." These comments were made when central bank raised the lending rates by 0.75%. That was the biggest increase since 1994, as Fed officials admitted that they're trying to slow down the market, tighten rates, and they are playing catch up. Similar increase is slated for July if the economic numbers come in as the Feds expect. The labor market cooled in May as non-farm payroll rose, but saw downward revisions for the numbers that have been announced in the previous 2 months. In addition, there's been some weakening in home construction, factory activity, retail sales, consumer sentiment in the last few weeks. This is a good sign, as slow and steady growth with lower inflation suggests that we have a shot at a soft economic landing. If the Federal Reserve Board can remain flexible and patient, the chance for a recession will be lower. Since the Federal Reserve is often blamed for big market drops, let's look at the other side of the coin. According to Goldman Sachs Group strategists, the S&P 500 has sold off at least 15% 17 different times since 1950. In each of those 17 instances, the market bottoms out only after the Fed shifted to a loosening of monetary policy again. As always, we are diligently assessing the economic and political implications for your portfolio. However, with the recent market turmoil and uncertainty, we want to point out the importance of a well-diversified investment plan. Along with that, for most of our clients, includes a percentage of assets protected from the market. If this is something you want to discuss more or learn more about, or you want to discuss your personal situation and portfolio, give us a call, give me an email, send it to jnorth@360ira.com. With all that being said, here is the disclosure I'm required to read. While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purpose or sale of any security. Please consult your financial professional before making any investment decision. Investment involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining markets. The indices mentioned are unmanaged and cannot be invested into directly. Past performance does not guarantee future results. Thanks again, Jeremy North signing off for June.